So just quickly wanted to go over some things. Unfortunately, we had a couple people step down over the past few weeks, just personal reasons, but that's just the way life goes sometimes. But some new opportunities for you guys. We have a treasurer role open, which is the head of finances, and a co-director of curriculum. As you can tell, these slides, we put in a lot of work to these slides, and we could really use a lot of help curating the content and coming up with new ways that we can change the programming and what we showed you guys. So basically for the treasurer, you're essentially just managing our Excel and managing our finances. With this role, you directly become an e-board member. If you're interested, just send me interest and I'll send you a quick little application. Nothing crazy. We just need somebody to manage our finances. And then for the co-director of curriculum, that as well, directly become an e-board member. And then, you're just logic checking all the presentations, reformatting. Really what we're looking for there is PowerPoint experience, and then for the treasurer, we're looking for Excel experience.
Would you guys be looking for somebody who's already had like a year in the club?
The more the better. Just anybody who's very organizational, and somebody, at least for curriculum, anybody who's willing to take feedback on the fly.
Yeah, for curriculum, like for a lot of the younger people in the room, I would view that as a very strong opportunity to build your resume, because not only do you get to design a lot of decks, you get to say that you're teaching these finance concepts to a room full of your peers, which is going to be very powerful for your interviews. And also in teaching these concepts, you become a lot more familiar with them. So you'll be working with me, and we're going to go through what we have planned out so far, planning out activities for you guys. So I would highly encourage as many of you as possible to apply for that position.
Should introduce everybody.
Yeah, my name's Alex. I'm the current co-director. Well, not co anymore. I'm the current head of curriculum. Been in the club now for a year since its inception. It's been a great time. It's been an amazing opportunity. It's opened up a lot of doors for me personally. And highly recommend, well, I look forward to getting to know all of you, but I highly recommend you guys apply to work with me at that position.
Yeah. So if you're interested, I'll send the applications in GroupMe later tonight. And if possible, try to submit your applications within a week.
One thing I wanted to pinpoint with the treasurer position that's a little bit different from other clubs is that as we mentioned in our last meeting, we're a nonprofit, so you would be handling those incoming donations that we would get from our advisory projects, for instance, or external donors. So that's another thing, getting a little familiar with how a nonprofit works, how to get that tax deductible donation and so forth. I think it's an interesting nuanced opportunity we have here.
Yeah, very cool resume opportunities for you guys. Just so happened that it came up this semester, so yeah, I'll be sending that later tonight. So, just like how we did last week, one thing we want to improve on this semester is be as transparent as possible with you guys, show you guys the growth of the club. So this week, we actually executed all the NDAs for Project Horizon. That's that neurobiology company we mentioned to you guys. And moving forward, we also want to keep things as anonymous as possible. So if you are on projects, we still want to provide you guys with updates, but we still need to keep things under wraps, like to a certain degree. There's certain things that we can say, but there's certain things that we can't say. So, for example, the neuro company is going to be Project Horizon, and anytime we give basic summaries on them, that's what we're going to be referring to it as. And then also for new projects, we'll say what the company is, and then we'll label the project. And then if you're on these advisory teams, you will also be signing NDAs, so you have a greater degree of confidentiality that you have to maintain. So just keep that in mind when you're applying to these programs. But yeah, so we execute all the NDAs, ready to go. For some of the people, the past members joining this team, we already have one potential project manager. We're still looking for analysts for the neuro team. We're going to be doing a debriefing today, and we will be going over more in-depth details about the project. And then for seed.
Okay, yeah. So this past week, we have been able to get the ball rolling on our most pressing commitment for your competition, which is the October 20th pitch competition that we will be putting on at the Seed, which is the big facility over at Santa Fe, the incubator that they have over there. So we've already sort of floated and funneled some people into organizing what that's going to look like over the next 4 weeks. But also one thing I want to stress about this pitch competition, it's something that we have the unique opportunity to have extreme creative liberty over this competition. Seed has really given us the opportunity to come up with the criteria for the competition, come up with the judging panel. And the judging panel will also include people from our organization on the panel, as well as community professionals, come up with the number of startups, what kind of startups we're going to vet, how many we're going to vet, how much time we're going to give them to pitch, what the event is going to look like. So from start to finish, all of it is in our hands, which is why it's a really cool project, and the ball is getting rolling on that. And we'll also do a debrief on that project after the meeting today.
And yeah, so I'd like to give you guys an update on FPD. I have been in contact with FPD. I'm our sector representative, and we basically came up with 3 different things that we had to talk about. So the first being, we are doing the Santa Fe seed competition and VCIC. So we're getting more hard deadlines with them since we are in close working with FPD, which is going to be helping us coordinate the VCIC competition. So towards the end of October, we're going to want to get all the like a rough draft and like a logistical understanding of what the VCIC competition is going to look like. So that's a big thing. Another thing is November 3rd, 4th, and 5th, we're going to have a lot of sector speakers from all the various sectors: consulting, IB, private equity, etc. And all of them are going to come in, and there's going to be a lot of speakers. It's going to be a really big FPD event that they want a lot of Warrington Venture students to go and attend and really just enjoy that networking event. So that's something that's on the horizon. And then another thing is that we need to come up with some goals for our actual club. So we're going to deliberate on that and then get back to you guys so you guys can see what the really end outcome of this club is too. So that's a little bit more about the FPD updates.
Cool. Thank you. All right. And like I mentioned, again, this is just another format that I want to introduce to you guys. This is our project dashboard. This is everything we've completed so far, everything we have in progress, and what's in the backlog. As you can see, very small list so far. There's probably some things I've left out just in terms of like level of gravity.
Project KVD, I was just a little confused.
Yeah, I was going to touch on
okay.
that. But Project Mars, the aerospace company we worked with last semester. Early Bird was the food and beverage that we worked with last semester. Wacky Sauce was actually a hot sauce company that was also owned by the Mars Aerospace company founder. And then we helped them with distribution and marketing. And then Project Atlantis was the one that Daniel mentioned last meeting. BCIC, that's the one we competed in. Small business case, another one we competed in. Project Horizon, already mentioned that one. And Project KVD is this project that me and Vinay are doing in the background. We're essentially acting like liaisons for Florida funders, which is the most active VC in the Southeast right now. And we're helping them basically we're functioning like VC scouts. So we're just looking for new deal opportunities for them. And there's some big things at the end of that if we're able to basically deliver. But KVD stands for another associate of ours called Carl, Vinay, and Dairo. So nothing crazy. But yeah, then the Santa Fe Fish competition that Vinay mentioned, and then we actually received a new UF Innovate project, very similar to the Project Horizon. More details on that soon. We're going to have a meeting with Innovate early October, I think, around there. We're still waiting for the calendars to come our way, but there's that. And then we have also new inbound for new competition in the spring, small business case comp, which I can tell you guys more about when we get more details. And then BCIC, like you mentioned, we still have to do a lot of planning for that. But yeah, that's everything right now. I'm going to show this to you guys every meeting as well. And then now we're going to get started with the current event discussion. We did this last week with Instacart. A lot has gone on with Instacart. We're also happy to talk about that. But briefly, this has been like the headline in terms of IPOs and private capital over the past few weeks. So I just wanted to touch on it.
Yeah, so this week's spotlight is going to be on ARM. It's a UK-based semiconductor company that has skyrocketed after its recent IPO. So they IPO'd at a whopping $68 as their price per share, which is extremely high in the market, and something we really haven't seen since NVIDIA, which is a huge tech company that IPO'd in the recent years. But yeah, so a lot of positive reception, a lot of buy-in from investors, and it's one of those rare sort of booms that we haven't seen since NVIDIA. And so it raises the question, what are investors, why are they excited about ARM's IPO? And one thing I want to touch on in recent events throughout the month of September. So they IPO'd at $68 per share. And actually, that has gone down significantly to $53 per share right now. Why is that? Because investors are looking for a quick pocket opportunity on this IPO. So many of the investors got extremely excited at the IPO coming out at $68 per share that they sold off their options. And so that's caused the stock price to decrease, but it's only because they got so excited about the cash grab opportunity from this IPO that you saw that huge sell-off. So it's kind of a double-edged sword, right? Because it's great for the investors, but the company's stock price kind of declines. So what's that balance, right? How do you manage a huge IPO while also not triggering a massive sell-off among investors? That's an interesting thing to keep in mind that kind of came up recently over the month of September. But back on that $68 price per share in the IPO, why does a company's stock price really go up after an IPO?
Stop right there. Let's give you guys a second. We did the same thing last week. Just take 2 minutes. If you haven't met your partner, just talk to them real quick. Quickly talk about the last point there. Is this a good sign? If it is, why? If it's not, why? Yeah, introduce yourselves and chat it up.
So, and there's such a right second question. When a stock is initially offered to the public, it's offered at a discounted price, so that when it hits the market, a lot of people buy it, and it attracts attention and thus more capital.
Yep, exactly. Take on to the hype.
Yeah.
Anybody else want to do an input?
On the second question or tonight?
Like, really what I want to get at is this overall concept of IPOs, and if this IPO in specific is good for the overall market.
I think it is good for the overall market because of just how bullish the IPO was and like how high the price raised to. I think it's a good indicator for other companies, who are right now like iffy about whether or not they should go public. Seeing that should be like a positive indicator, showing that investors are open to investing in recently public companies.
Price dropped though, right?
Yep.
It didn't.
Do the
It was
options,
bearish. Like that. Do you say that bearish?
Didn't it start at 68 and go to 50?
It goes down.
Yeah, now it's down to 52, but
So.
One thing I want to ask you guys is, do you guys know who the lead underwriter for this deal was, by any chance?
no.
It's a Japanese bank called SoftBank, and
Oh.
supposedly, what SoftBank does a lot of times is that it issues these IPOs at very high prices, and they're very bullish with all of their IPOs. They're never conservative with their prices. So a lot of people are saying like, oh, calm down. Like, this is just SoftBank doing another IPO, and that's basically why the stock price is dipping down to the way it is. It's way too bullish of an IPO right now. It's coming down to fair value, and that's what we're sitting at right now. So just keep that in mind, and a lot of what we're going to go over in venture capital, there's a lot of this hype but you need to learn how to get rid of all that hype and just actually like look fundamentally at this business and look under like all that smoke. So that's something I want to bring up. But yeah, being cool. What's next?
We'll start.
Yeah, go ahead.
Okay, guys, last week we did introduction to fund structures, and this week we're going to talk about valuation. So we're splitting valuation into intrinsic and relative valuation. So we decided to start with relative valuation because intrinsic is a little bit more complex. So relative valuation, you have your comparables, companies analysis, and your present transactions analysis, which we're going to be covering today. Intrinsic valuation, you have your DCF and your LBOs, which we're going to be covering in the next 2 weeks. So relative valuation, we broke it down into kind of a 3-part framework for you guys that we're going to keep on going back to. First part of that is, what is the market pricing comparable assets? How can we generate comparability using variables? How do we adjust for differences across assets? Anything to add?
Yeah, and then one thing I'll say is relative valuation, remember that it's broken down between comparables and precedents. We'll go into next later on what precedents are. The comparables is essentially just comparing your target company to its peers. Now we're going to go over like how that's basically done. And essentially, a lot of venture capital and private equity, there's not a lot of public data about these companies. So the only research that you can do is comparable analysis. And a part of the advisory program, this is a lot of what you'll do as well. It's a lot of comparable analysis. We really want to drill this into you guys and understand the different ways that you can basically put everybody on the same apples to apples field and how we can just focus on this one company we're trying to research.
So starting off, it's broken down into 5 steps. The first step is to select the universe of comparable companies. The second step is to locate the necessary financial information about the company. Then you're going to spread key statistics ratios and calculate your trading multiples using those financial statistics. Then you're going to benchmark those numbers, and then you're going to determine your valuation. So again, you have your relative valuation framework. A comparable firm is one with similar cash flows, growth potential, and risk to the one that we're trying to value. The first part of this framework is, what is the market pricing comparable assets? So step 1, select the universe of comparable companies. When you have your target, you're going to split it up into 2 dimensions for analysis that can be split up further. So in your company's, in your target's business profile, you're going to look at its sector. What industry is the target in? What products and services does the target sell? Who are the customers and end markets of the target? What distribution channels does the target use? What geographies does the target company operate in? In terms of your financial profiles, you're going to look at the size of the target in terms of, and you're quantify that in terms of enterprise and equity value. What are the profitability metrics of the target? What's the growth profile of the target? The ROI and the credit profile. And a lot of times, you're going to use this analysis of the target to find similar comparable companies. A lot of times, you're not going to find 10 out of 10 matches across all of these dimensions, and that's when we say it's more of an art than a science. It's having the discernment to know when it's okay to use a certain combination of these to make the conclusion, this is a comparable company to my target. So how are you going to find a lot of these ratios, a lot of these metrics? There's 2 main avenues we can go down. The first is SEC filings, which is publicly available. You have your 10K and your 10Q, which is your annual and quarterly reports. You have your 8Ks, which are events relative to shareholders. The SEC requires companies to release a document that kind of outlines what those events are. It's going to have current financial information. Then you have proxy statements as well, which describe when different items are up for shareholder votes. And you're also going to have equity research. So private companies will provide a lot of these research reports, consensus of estimates. You can access firms, your target's press releases and the comparable sets press releases. And then you can use financial information systems like Yahoo Finance, Google, and other free resources.
Wait, I want to hand real quick. Daniel, for this slide right here, how would you say you researched Sat9 and did you use any of these when you were researching comp sets?
Research reports just to see the technology because that was their main focus.
Any other databases or anything that you utilized?
From them, no, because it was a private company, so a lot of these options weren't available to us.
So what would you use essentially to get the
Use a
research?
comparable company.
Okay.
In that case, we use a company called Planet Labs, which is a similar company, very large in the public space.
And here's an example of kind of what Daniel was talking about. This is JP Morgan's kind of research platform. Obviously, this is very institutional, not very accessible to us as like individual investors. Did I ask you a question? You see they have research and insights, data analytics, portfolio solutions, pricing execution information. And then you look over here on the right, this is Morningstar Investor, a lot less institutional, but still kind of like the same principle. Just providing research tools that's going to have a lot of the information for us. And again, this is a chart from the source material that kind of just goes into more detail about each of those line items, where you can find them. And we have listed right here great sources that we can access as students: SEC.gov, Yahoo Finance, investor presentations, can be data rooms or accounting softwares when you're actually in the field. And this is just an example of what a research report kind of looks like. This is JP Morgan's research on Tata Steel Limited. You can see you have your target price and recommendation. And they're going to derive that target price using the techniques that we're going to learn here. They're going to have a headline. They're going to graph out the stock performance versus the index performance. An investment report summary that just goes into things that are happening with the company, and financial analysis and stock data. So here's what a consensus estimate looks like for Apple. So you have the high consensus, the average consensus, and the low consensus on a 12-month forecast.
One thing I also want to bring up is, as students, we also have access to the Bloomberg console in the West, and I think a couple other areas as well.
The Capital Markets Lab.
The Capital Markets Lab. I think in Q, right?
And yeah, and
yeah, so you can't just look up JP Morgan Equity Research Report for Apple. Like, you won't be able to download that. You need to literally go to Bloomberg, the console, the actual subscription, go into the console, and then look up what I just told you, and then you'll be able to download it. So if that's something you guys are interested in, that's the way you have to get to it. Because these research reports, like these actually researchers get paid for this, so you can't just download it.
And that's something that you'll realize is a lot of times you're limited. Like these tools and these techniques for finding value of company are very limited by the information that you have and the quality of information that you're able to get. So like, why can someone who uses JP Morgan's tools generate better returns in the weekend? Because they have better information than us. And there's smart people that are sitting at a desk and generating all this information, and they put it behind a pretty hefty paywall. So as students, we can access the Bloomberg terminal, but when you're out in the real world and you're just an individual, that's a very expensive tool to ascertain. So the second part of the framework, how can we generate comparability using variables? So these are those 5 financial profiles that we mentioned, and these are just a snapshot of the different ways that we can quantify some of these categories. So with size, you're going to look at equity value, enterprise value. The difference here being enterprise value is really just the value of the entire firm, including debt and equity holders, and equity value is the value of just the equity. Key financials are going to be sales, gross profit, EBITDA, EBIT, net income, profitability, gross profit, EBITDA, EBIT, net income again.
Sorry, can you explain where you would find these key financial metrics like sales, gross profit?
Yeah, so you could find them in the 10K and the 10Q, a lot of those SEC filings. Obviously, all those research reports are going to have those included. And then a lot of that, there's like financial information services that I mentioned. Like you could look up the stock price of AT&T on Google. Yahoo Finance kind of takes the information from the 10Ks and the 10Qs and can give you a very digestible like balance sheet and income statement to use. So that answers that question. If you have a growth profile, show when estimating growth rates, return on investment, metrics like return on invested capital, return on equity, return on assets, and dividend yield and credit profile, how leveraged the firm is, how well it's covering its debt service and credit ratios. And again, these are these 5 categories. So how do you determine size? You determine size across 2 dimensions, equity value and enterprise value.
Yeah, sure. I guess you guys aren't too familiar with this equation right here. This is equity value. It's basically just your market cap. When you Google on Yahoo Finance market cap of Apple, we get a huge number. Like I think they're at like what, 3 trillion now?
Yeah.
Not trillion? 3 trillion?
I think they're in the trillions, I don't know.
Whatever. Big numbers, right? That's this calculation right here. Question I wanted to ask you guys was though, why do we use fully diluted shares instead of just the common stocks of a company? Ethan.
Maybe, I have no idea.
What was the
Does
question?
anybody else want to guess?
What was the
The
question?
difference between diluted and common.
Instead of just common stock, why do we have to use, when we're finding equity value, fully diluted shares?
Like convertibles and options?
Exactly. So there might be employee option programs, or there might be options, convertible notes that the company might have. And in order to get true value of what an equity or share price would be, or equity value, you need to fully dilute all the shares. So this number would become a lot bigger. So that's just some way that we would do that. But yeah, I just wanted to bring that up. What else am I missing?
And then enterprise value is just the equity value plus the net debt. So that's why you see this equation where the debt, you're subtracting the cash equivalents. I'm assuming that just because they're just taking out the amount that you have on hand to pay off the debt. Profitability, these are just these equations I mapped out for you guys: gross profit margin, gross profit over sales, EBITDA margin, EBIT margin, net income margin, all of those line items over sales. Your growth profile is typically quantified and communicated in terms of earning per share growth rates. And you can see here, they're trying to find the compounded annual growth rate actual between 05 and 07 is 14%, and they're able to find the average for what the estimate is going to be for 08 and 09 from a consensus estimate. And then you have your profitability metrics, your return on invested capital, return on equity, return on assets, your implied dividend yield, which is the dividends over the share price.
For here, I wanted to bring up, do you guys think a company with a higher dividend would have more growth or less growth?
I think they would have less growth, because
Why?
when I, just from like experience, like learning about different companies and like low growth companies generally tend to be like companies that tend to be quote unquote farmed, as in like they're meant to be sustained for their cash flow, and they have a high yield, they have a high dividend, so that investors will invest in their stock.
That's for long, like much more mature companies.
Yeah.
Okay. Yeah. Essentially, a dividend is, if you guys, when you take financial accounting, or if you have, it's basically after your retained earnings. So it gets netted out of your retained earnings. It's not your true profit. So it's anything in excess of what the company earns. So if the company is able to give out dividends, that means they're a longer-term company, much more mature. But if you're a high-growth startup, for example, you don't have any excess cash to be able to give to investors. So you reinvest all that back. That's another thing also to keep in mind when you're valuing these startups or these businesses, thinking of their run rate.
When you do have excess cash, you'd rather invest in it.
Exactly.
Credit profile, you're going to look at your capitalization ratio, which is pretty much just the ratio of debt to, that looks like, is that enterprise value?
Where? Oh yeah. There's a lot of ways to calculate EV. That's the very basic way. Did you go over NCI, by the way? Not controlling interest. I just real quick want to bring that up to you guys. That bottom part of the exhibit 1.21, that's enterprise value. Just think of that being like, if I wanted to buy this business today, like what would be the dollar amount of the purchase? And that's EV. So you got debt, preferred stock, and then non-controlling interest is essentially like any form of a subsidiary that the company owns that you need to add also into that combination. So it's like any minority equity investment they have in another business. That's NCI. And equity is equity.
You have your interest coverage ratio, which is a measure of how well can the company's, the cash flow that it generates cover its debt service. Then you're going to have your leverage, which is your debt over your EBITDA. Just a multiple of how much debt the company has in proportion to the cash flow that it generates. And this table is a spread of how like credit quality of companies are communicated in the finance world. So the three main credit agencies, which are Moody's, S&P, and Fitch, what they're going to do is they're going to give each publicly traded company a rating based upon their creditworthiness, which is really an indication of the financial health of the company and the ability of the company to repay its debt. And then they each have kind of different striations in quality, and then there's a line here that delineates whether or not an investment is investment grade or non-investment grade. If we were talking about this as it pertains to bonds, non-investment grade bonds would have higher returns because they're more risky.
Talk. What's the most credit-worthy company that you can think of?
Creditworthy.
Yeah.
Great question. I don't know, Amazon?
Amazon could be.
Doesn't Microsoft have a AAA rating?
Yeah.
How would this like apply, like if you wanted to use it for valuation of like startups? Is there companies out there that kind of give ratings out to startups?
Most startups wouldn't have a credit rating yet.
Right. Is there a way like you can apply this kind of knowledge?
I mean, fundamentally, what makes a company more creditworthy is their ability to pay back debt. And you can't compare an Apple to a pair of co-founders that are coming out of college who don't even have a business yet. You can't even put a credit rating on them because they don't have any revenues or anything of that nature. So, you know, there probably are agencies that try to credit rate them, but that's probably for like early stage companies or Series A companies.
Like, there's a certain level, there's a certain point you have to be at to even get signed in the first place.
Is there any, how would you rate the credit worthiness of a startup? And I guess my second question attached to that is, would it even be worth it to credit rate a startup? Because you're investing in it for its exponential growth potential, not exactly its ability to pay off debt in the short term.
I mean, the way that I would answer that question is like implicitly a VC is like credit rating a startup, like when they decide to invest in it, they're weighing all the risk factors involved with the founders and the other financial indicators that the startup might have.
No, that's exactly what I said.
So there's no credit rating, it's just whether or not you will or will not invest in them.
The question is whether or not the company could actually 10x my investment.
I mean, think about it like this: like you drive down the street, like think like JJ's doesn't have a credit rating. You know what I mean? Like these companies don't have time to rate Joe Schmo's bagel store. Like they have to, or Joe Schmo's startup. Like there's a finite amount of ratings that they can give out, and they pretty much reserve them for publicly traded companies that people care to know what the ratings are. And there's a big real estate application for this in terms of like your company's ability to sign an office or retail lease. Any other questions? Those are great questions. Okay, so once you have all that information, you're gonna get into the fun stuff where you calculate the key trading multiples. For comps, our source material lists equity, these as the relevant equity value, enterprise value multiples, your share price over your diluted earnings per share, and your equity value over net income, your EV, excuse me, your EV multiples, your enterprise value over EBITDA, and your enterprise value over EBITDA. The last part of the framework is how do we adjust for differences across assets?
Quick question, if you go to the slide back, and what do these multiples tell you?
So, like enterprise value over EBITDA, using that one as an example, if you think of the enterprise value as the value of the entire company, what's going to tell you is, as a multiple of the cash flow that the company generates, how much is the company worth? Does that make sense?
Remember how I said that EV is the purchase price of this company? So for every dollar that I'm paying, how much money are they actually generating?
Think about it like this: if you're an investor and you have a high enterprise value to EBITDA multiple, you're willing to pay more money for every dollar of cash flow. If the enterprise value to EBITDA multiple is low, people just value that company less because every dollar that cash flow generates, they're willing to pay less for. Does that make sense?
Yeah.
And you can think about that the same way for any of these types of like enterprise value for EBITDA. It's the same kind of concept.
Yeah, and another thing too, a part of this framework was comparability. So I think we're missing the slide on different comparable metrics that we use for different industries. But EV to EBITDA, that's like the main one for like tech companies, because if anybody knows what EBITDA is, it's earnings before interest, taxes, and depreciation and amortization, right? So it's like, what can, like, after everything, like, what does this company generate, like, after everything, or before everything, I'm sorry. So that's why they use EBITDA. But like some industries might use the EBIT, or some might just use EBT. It just depends. Like,
Yeah, we are missing that slide. Like, I saw when I was making the PowerPoint, I put that chart in, like some tech companies like have like subscribers, like over, it's like subscriber to EBITDA ratio. So like if they have like millions of or billions of subscribers, and they're gonna see like the multiple of EBITDA to subscribers, and like for like telecommunications companies, it's like the amount of like viewership that they get. So there's kind of a lot of different ways to spread out these financial statistics, and it's like Diagram mentioned, it's very industry specific.
yeah. And that's what the cool thing, a part of the advisory program is. Like, you would have to come up with a certain way to compare the business that we're targeting to the actual universally comparable companies. So, for example, like I could ask you guys right now how you compare biotech companies. It'd be a hard thing. Like, honestly, right now I can't tell you how I compare those companies. So that's the type of experience you get part of advisory, and that's a lot of things that VCs and private equity professionals do as well. So I just wanted to bring that up.
So the third part of our framework is how do we adjust for differences across assets. Oh, here it is.
Oh yeah, there we go.
So, yeah, I'm trying to find the one that I was talking about. Yeah, subscriber, media telecommunications,
Is biotech there?
I don't see biotech, you have broadcast cash flow. I mean, production capacity in units,
Maybe.
population, for the population that they can reach for like a telecommunication.
Oh, but like looking at like consumer discretionary, you use like EBITDA. So they take into account rent expense. And as you might imagine, a casino might have a huge lease that they have to basically maintain. But yeah, this is what I was talking about.
Literally for like a biotech firm, would you have an idea like what they would put
That's what
EV
I'm
over?
looking for. I'm not entirely certain.
That's something to just search up later.
Yeah.
Yeah, we can get back to you with that information. I'm curious as well, like what science companies would use. But this is really where it gets into like, it's more of an art than a science. Like if you're a really skilled analyst and like you discovered some type of strange multiple that gives you like the most kick-ass valuations, then yeah. So this is kind of what it looks like when you're spreading it on an Excel table. Here you're gonna have your enterprise value over revenue and your enterprise value over EBITDA. You have these multiples for the last 12 months. And then for in this instance, these are future years. You also have your PE multiple here. And then you can see this is for a bunch of like metal companies. You can see kind of a comp set. And so for your last 12 months, you take all these multiples and you calculate a median, and then with that median, move back into an enterprise value, back into an equity value, and then eventually find the implied share price.
I just had a quick comment about the biotech companies. So, biotech companies, they invest a lot of money in R&D because they're always trying to research and develop new drugs. So one of the ones I found was EV over invested R&D. That's a pretty common one that's used. So you can see how much the company's valued for every dollar of R&D expense that they're investing in.
There you go. Great. Thank you. And then here from that, you find, this is just showing like that data spread, this range of multiples that you would use, and then you would typically, I think it's more common to use the median. Well, it depends on if there's an outlier or not, but even if there's no outliers, you typically use the median.
Yeah.
And you have your low and your high, and then again, you would use that range that you find from looking at these multiples from the offset to back into an enterprise value, back into an equity value, and get your implied share price.
Well, I mean, when I was doing forecasts over the summer, I use a lot of the times the average. But as you can tell, most of the time the median would be really close to the mean. So it's very, like, it's not as material as you might expect, but sometimes it does push the needle a little bit more. But Alex is right, like, you use median most of the time.
But is the multiple range for like industry, like where do you get like the 5 and the 8 and then the 6 and the 7, like selected multiple ranges? Do you just choose them, or How
No,
does
so
that,
like-
how do you generate the ranges?
Yes, that would be like right here. So we're trying to find like the current implied share price. We would have our, and we want to use for that calculation, the enterprise value over revenue multiple. You have your last 12 months and you have this calculated for these companies, and then using that you have the maximum here, which is that 1.2 that you see, and then you have the different percentile levels and you get your 0.7. So that would be like your median number. So that's what you're going to see here in this median number. And then you have like the low of the range would be here, the high of the range would be here. So these multiples here are, in this example, the spread for enterprise value to EBITDA with this comp set that you're seeing.
Oh, I see.
Does that make sense?
So this is the range for like all the companies in your comparable
Yes.
company set. Okay.
You good? Is everybody, okay. Yes. Okay. Pros, it's market-based, it's relatively easy compared to like DCF, and it's using current financial metrics. Cons is that it's also market-based because the market doesn't always price things effectively or efficiently. Do you have anything to add to that? The market can sometimes do weird things, and you can't always trust the market. There might be an absence of comparables. You're like you can't really find comps for like Apple because of how big it is. I mean, you could, but potential disconnect from cash flow. Again, that's the difference between like relative and intrinsic valuation. And then there's like different company-specific attributes, like different strengths and weaknesses that the company might have inherently that you're kind of missing out by looking at, trying to get the value for your target company by looking at other companies. Do you have something to say?
Yeah, I was just gonna say the market-based. So just thinking about like COVID. COVID impacted various businesses very differently. So when you're doing a comparable companies analysis, it can maybe skew your like the comp set that you get and the valuation that you get. So an interesting multiple or an interesting metric that they came up with during COVID was EBITDAC, which is earnings before interest, tax, depreciation, amortization, and COVID. So that's something that they were using. So just an interesting point.
Okay, now we're on precedent transactions, which goes a lot quicker. So just stick with it, guys. The precedent transactions method of company valuation, very similar to comparable companies analysis, where past mergers and acquisitions transactions are used to value comparable business today. And it's the same framework. We're going to look at what is the market price in comparable assets.
So keep in mind that EV number. So how many times has this company transacted in the past? How many companies have been transacted in the space using this value?
So instead of screening for comparable companies, you're going to screen for comparable acquisitions. And it's a very similar process in terms of it's acquisition of comparable companies, essentially, right? So it's a similar process in terms of like coming up with the conclusion as to whether or not the underlying company behind the acquisition is actually comparable. How are you going to do that? You're going to search MMA databases, examine target mergers and acquisition histories, examine comparable M&A history. So you're going to look at the comparables, look at their mergers and acquisitions histories, search merger proxies for comps, review equity and fixed income reports. Other considerations are market considerations and deal dynamics. A good example is like the acquisition of a bank that fails. So like if UBS buys Credit Suisse is under certain stress, and like UBS has incentives from the Swiss government, that might not necessarily be the best precedent transaction to use. Yeah. Deal dynamics are kind of very similar. If kind of there's a company that is in duress and it's being bought, there might be things that you don't know where the company wasn't bought for a fair market value they need to consider here.
I was going to say, also bringing back that EV number. In that situation that Alex mentioned, if you guys remember, UBS buying out Credit Suisse and then just buy out this company and then just pay off that debt over time. Or do I want to be kind of like a little bit more sophisticated, maybe use 60-40, 50-50? It depends. It depends on how much cash that company might have, which is the buyer, or how big the company is. A lot of times there's this thing called mergers of equals, where two companies of the same size want to merge with each other, but one of them can't exactly buy out the other. So they both essentially put down the capital to form a new entity. And that's like a whole other concept in M&A. But essentially what I'm trying to get here is that transactions for companies can either be all equity, all debt, or a mix of the two. Most of the time it's 60-40 though.
Kind of going into our previous conversation, there's also adjustments that have to be made when you're looking at when you're looking at these considerations and you're trying to ascertain the value, what kind of number, quantify how much value was exchanged, there might be a premium paid or a discount paid. And you also have to account for synergies. So when a company merges, if it's a kind of a good fit and if the merge was intelligent, there would be benefits to merging. It would bring the cost down of the new entity that's formed as a result of the merger, and you have to account for that as a deal adjustment, changes to the underlying financial profile of the company after the merger is made.
Yeah, a point on synergies as well, which is a huge concept in finance. It's how well this company is coupled with this other company. So there's this huge chain in New York called Sweet Green, and they're essentially like a Chipotle. They basically source everything from farms. And they recently bought a company that automates all of their food production lines. Like, instead of having a worker in the back cutting up chicken and serving salad, like they literally have a robot dispensing food. And they bought a company in order to do that. And they opened their first store, I think it was in Ohio, if I'm not mistaken. I have to double check that. But essentially that company that they bought out has tons of synergies, because in the long run, you can imagine how much cost savings they'll get. Cost savings, you could just imagine, like, instead of spending a whole bunch of money in the long run, they actually save them a lot of money, which gets converted to more revenue in the long run. But that's just one way. Another way to think about synergies is, like, you can't mix like two very big businesses together. Like, you can't mix a biotech with like a retail company. Like, it just doesn't make sense. It's like a Lego piece. If the piece fits, then you'll have tons of synergies, which increases the value of the transaction immensely. And most of the time, companies try to lean towards synergistic companies.
That's a great example.
What's the stock for stock transaction?
Yeah, I forgot to touch on that one. Most of the time, instead of cash, the company would actually give you some stock of their own. So the stock might be valued at $30 a share. So instead of basically giving you like $1, you'll have every share is worth $30. So it's like worth a lot more. But another concept that you'll learn in the long run is that the cost of equity is way higher than the cost of debt. It's very, very, very cheap to use debt in the long term. So that's why a lot of private equity, that's essentially what they do. They do leverage buyouts, which is a majority debt with a little bit of equity, or a little bit of cash, or a mix of the three. So
we're going to cover those in detail.
Yeah, we'll cover that later on, but I forgot to mention that, but good point.
So the second part of our relative valuation framework, how can we generate comparability using variables? Again, you're going to have your multiples for precedent transactions. If your offer price per share over diluted EPS, your equity value over net income, EV over EBITDA, EV over EBIT, and EV over sales or revenue. And the third part of our framework, how do we adjust for differences across assets? And here's the Excel spreadsheet for the precedent transactions. You can see you have the acquirer, the target, and this is metal steel companies acquiring these targets. You have the kind of the percentage acquired, the enterprise value of the transaction, then you have your multiples, your valuation multiples here. So you're using the enterprise value of the transaction, so calculating how much they bought it for to calculate these multiples. And it's the same process as comparable companies analysis, where you're going to take this, you're going to find your spread here. So if you want to find the current implied share price of using equity value, using enterprise value over revenue, you're going to look at this column, and you're going to use this medium, and you're going to multiply that. You're going to multiply that by your enterprise value and then back into your implied share price.
Where do you get these tables?
I was about to say, so unfortunately, since we don't have access to PitchBook, most of the times we'll probably produce a simplified version of this for the companies that we work with. But if you're a professional, you can literally, with the click of 2 clicks of your mouse, get this whole table from PitchBook, from CapIQ, whatever database you use. Like, this is already pre-made for you. So,
or you build it out yourself.
It's hard.
Yeah, it's not easy to build it out yourself. But you could.
Do you know if there's any like programs that us UF students have access to that to do something like this or anything close? I know Bloomberg, you can like generate Excel tables, but that's a little bit of a longer process.
Bloomberg would be the best bet, but even then, like, you have to pull up
You probably have to make yourself a template
Like-
and like populate a lot of the information yourself.
That's what I was gonna say. If you literally want to, so the way that I approach it is like, pull up all their 10Ks, get Adobe Acrobat, learn functions on Adobe Acrobat, pull up an Excel, list their names out like this, do a tab for every single company, and then put out their income statement, their balance sheet, their cash flow statement, and then build out a three-statement model, then build out a DCF, then build out the EV to, it's a whole process.
What's a three-statement model?
It's essentially just.
We'll go through that too,
We'll go
eventually.
through that later.
But it's not easy to do, and that's why like it's easier for the institutions to make money on the stock market, just because they have the tools, they have the resources, they have the smart people working there that are capable of doing all these things. They can do this easily and way more efficiently than you or I could.
Yeah. And most of the time, like, if we're working with startups, they'll already have, like, they need to present to investors, so, like, they'll have these numbers ready to go. At least their income statement. Like, if they don't have an income statement, like, bro, what is going on?
Okay,
Well, actually,
I think with this, okay, pros and cons, last slide about the Precedent transactions. Pros and kind of similar, it's market-based, for the same reasons as comparables. You can't always trust the market, but then you like to know what other people are valuing the business. This is very simple of all the valuation methods, so it's value for one of the pros is its simplicity. It's current, which I think this might be an error because one of the biggest cons is that there's a time lag with all of those transactions. Pros is that it's very objective. So instead of comparables, looking at like what the stock market is valuing companies, you could look at what people are actually purchasing companies for, which gives it a lot more objectivity. Cons is a time lag, so like obviously you're not going to have you're not going to have like 20 amazing person transactions with comparable companies that took place 5 days ago, so you're going to have a little bit of a delay in terms of how you get to all those valuation estimates. Available comparable acquisitions, that could be a big thing if you just can't find enough comparable acquisitions in like a reasonable time frame. And then information availability, as we just alluded to, it can be very difficult to get all of this information. Yes.
Why would there be such a big time lag?
So, kind of like how I mentioned, like if you want to find like a spread of a bunch of these transactions, like these aren't just gonna, like you can't just, these are big transactions that are taking place, and there's a finite amount of like steel companies, for instance. And so when you look at these dates are all very different, like when these were all announced. Like these aren't all gonna happen, like you're not just gonna have a bunch of these, you could be like, okay, I have like the most recent information in terms of when this transaction took place. All these took place last week, like that's never gonna happen. So you're gonna have a bunch of transactions you're gonna look through. Some of them might be very old, and some of them might be sold that you just can't use them anymore. That makes
So it's
sense.
mostly from like the lack of like the comparable like acquisitions. Like there's not that many, so some of them are
Right.
like older.
Right, exactly. And like there's definitely a limit to
Right.
where you wanna draw the line somewhere. Like you can't use stuff like pre-GFC, for instance. I mean, you probably can't even use stuff pre-COVID just because it's a different world that we live in now. So.
that's the point I was gonna make. There's an asterisk on every one of these transactions. Like 2012 is a whole different year compared to 2020. That's COVID, right? And for example, the point of last week with Instacart, a year ago they were valued at what, 24 billion, right? And then now they're valued at 9 billion. Why were they valued so high back then? It's because it's different market conditions. So that's where like the in-depth analysis of precedents come from. It's like, why did this transaction happen, and what was the environment of when it did happen? Why did it happen in the first place?
So when it comes to precedent analysis, the environmental conditions of that transaction are very important to its
The
valuation.
market conditions.
It's essential to look at why the deal occurred, because there's some deals that might be like comparable like companies that had a transaction, but there were different deal dynamics that you just can't use that deal.
Yeah, and if you also look at the transaction EV value, you see the older the transaction, the lower the price. But over time, you see how much higher it gets. Like in 2019, we have an all-time high of like 33 billion. Is that 3.3 billion? 3.3 billion. So it's like a lot of the times it's like I'll use a past transaction. You will use a past transaction to justify a higher premium. So like, oh, like this company was sold at 700 million. I think I'm worth 900 million because of X synergies with your company.
See, and that should be kind of solved because you're looking at the multiples. So like even if the currency inflates, like you should see some type of stability across multiples. So you could also, I don't know if you necessarily see it here, but you might see like a trend in terms of the EV to EBITDA multiple is trending up, which would suggest that people are paying more of a premium for these companies as a function of time, but it doesn't look like we see that here. Yes, sir.
I think another thing that's really important to note is like during COVID, a lot of investment banks do this, where they compare deals like that were during COVID time to like maybe deals that were like, say during like the .com bubble or during like 2008, and deals during those times, so it's easier to compare market conditions and kind of eliminate that as a factor.
Very good point. That makes sense.
Does that take into account inflation? Like, I see 20 years, like, could be a lot.
Yeah,
And,
exactly.
Doesn't take,
Well, it does because your revenue would inflate, but then your EBITDA would inflate too,
Oh, okay.
right? So when the fact that you're looking at a multiple, like that
so that
normalizes
is
for
very
inflation.
Yeah.
Yeah.
But not only that, but when you're justifying when you're finding your enterprise value, it depends on how the companies are getting it, but inflation is always taken into account in your growth rate. Like, you always have to back that up.
Good question though.
Yeah.
Cool.